Every single person who has ever built serious wealth through the stock market started at the exact same point, not knowing what a stock actually was, not understanding why prices move, not having any idea what happens to their money once they press buy. And yet somewhere between that starting point of complete confusion and the end result of genuine financial freedom, something clicked. A concept landed in a way that made the whole thing suddenly make sense. This video is that click. Not a surface-level definition pulled from a textbook. Not a lecture full of jargon designed to make the subject feel more complicated than it is. A genuine, clear, complete explanation of stocks, built specifically for the person who is serious about building wealth and is done waiting to understand the single most powerful tool available for doing it. My name is Tomas, and this channel is about finance, automation, and building real wealth starting from wherever you are right now. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are covering everything you need to understand about stocks, clearly, completely, and with one goal in mind: making you genuinely dangerous with this knowledge. Let's get into it. Let us build this understanding from the ground up, because the people who actually make money from stocks are the ones who understand what they are buying, not just the price it is trading at. What a stock actually is, and why owning one matters. A stock is a fractional ownership stake in a real business. When a company wants to raise money to grow, to hire people, build new products, expand into new markets, it can divide ownership of the business into millions of small pieces called shares, and sell those pieces to the public. When you buy one share, you own a tiny fraction of that company, its assets, its future earnings, its long-term growth. This distinction, owning a piece of a business versus owning a price on a screen, is the most important thing to understand about stocks, because it completely changes how you think about them. A price on a screen goes up and down based on what people feel like paying on any given day. A business grows or shrinks based on how well it serves its customers, how effectively it manages its costs, and how much economic value it creates over time. Investors who think in terms of business ownership make fundamentally different and fundamentally better decisions than investors who think in terms of price charts. How stocks generate returns, the two mechanisms every investor needs to understand. Stocks generate returns for investors in two ways. The first is price appreciation, the stock becoming worth more over time as the underlying business grows, becomes more profitable, and creates more economic value. A company that doubles its earnings over 5 years will in most cases see its stock price roughly double over the same period, because investors are willing to pay a similar multiple of earnings for a business generating twice the profit it was before. The second mechanism is dividends, cash payments made directly to shareholders from the company's profits. Not every company pays dividends. Many reinvest all profits back into growth. But established, profitable companies in stable industries frequently distribute a portion of their earnings to shareholders on a quarterly basis. A dividend is the most direct form of investment income available, money that arrives in the account simply for owning the shares, without selling anything. The combination of price appreciation and dividend income, compounded over long time periods, is what produces the extraordinary wealth-building outcomes that make stocks the most powerful financial instrument available to ordinary investors. Why stock prices move, and why most of the movement is noise. Stock prices fluctuate constantly, every trading day, every hour, sometimes dramatically within a single session. Understanding why they move is important. Understanding why most of the movement should not influence a long-term investor's decisions is even more important. In the short term, stock prices move based on sentiment, news, economic data, analyst upgrades and downgrades, social media trends, macroeconomic uncertainty, and the collective emotional state of millions of investors making decisions simultaneously. These forces are real, but they are largely disconnected from the underlying business value on any given day. A company does not become 20% less valuable because a news headline caused a sell-off. A company does not become 30% more valuable because a single earnings beat created a buying frenzy. In the long term, over periods of 5, 10, and 20 years, stock prices track business value with remarkable accuracy. The noise of daily sentiment washes out. The signal of business performance comes through clearly. which is why the most consistent and reliable approach to building wealth through stocks is not predicting short-term price movements. It is identifying businesses with durable competitive advantages and long-term growth prospects, and holding them long enough for the business value to be reflected in the price. The two types of stock investing, and which one is right for most people. The first type is individual stock selection, researching specific companies, evaluating their financials, assessing their competitive position, and building a concentrated portfolio of businesses the investor genuinely understands and believes in. This approach can generate extraordinary returns when done well. It requires significant time, analytical skill, emotional discipline, and genuine knowledge of the businesses owned. Warren Buffett does this exceptionally well. Most investors who try it do not outperform the market after fees and the time invested. The second type is index fund investing, buying a fund that owns hundreds or thousands of stocks simultaneously, tracking a broad market index like the S&P 500. Instead of picking winners, the investor owns the entire market. When the economy grows and the businesses inside the index create more value, the investor's portfolio grows with them. The expense ratio is minimal, often below 0.05% annually. No research required. No emotional decisions about individual companies. The returns are the market returns, which historically have averaged approximately 10% annually over the long run, and have made patient, consistent investors genuinely wealthy over decades. For most people, including people with sophisticated financial knowledge who simply do not want to dedicate their life to stock analysis, index fund investing is not a compromise. It is the superior choice. Not because it generates the highest possible return in the best-case scenario, because it generates a consistently excellent return with the lowest possible cost, complexity, and emotional burden in the real-world scenario where most people live. The wealthy people who built their fortunes through stocks are not divided between those who picked stocks and those who owned index funds. They are almost entirely divided between those who started early, stayed consistent, and held through every downturn, and those who did not. So there it is. Stocks explained for the person who is serious about building wealth. A stock is a fractional ownership stake in a real business, not a number on a screen. Stocks generate returns through price appreciation as the business grows and through dividends paid directly from company profits. Short-term price movements are noise driven by sentiment. Long-term price movement tracks business value with remarkable accuracy. Individual stock selection can generate extraordinary returns but requires genuine expertise and time. Index fund investing delivers consistent market-level returns at minimal cost and is the right choice for the majority of investors who want to build wealth without making it a full-time occupation. The market does not reward complexity. It rewards patience, consistency, and the discipline to stay in the game long enough for compounding to become undeniable. You now understand stocks. The rest is action. If this video finally made stocks click for you, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.